just telling Yogesh that after Kohli has achieved the target, why do we need to have further session or a further packing going on? We can declare this seminar as closed, but maybe we need to go ahead, and there will be some starting similarity which you will see. There is a presumption you all can make that me and Yogesh did this jointly, but the fact of life is it's not so. He did say something which I can say for myself but not for him, that according to him great people, or according to Bansify, it's often said that great people at times things alike and fools seldom differ. So giving first part to him and second part to myself, let's start with this. As you know, Yogesh very rightly put it, it's now going to be taking one similarity of dialogue from one of the films, is substance, substance and substance. So one will have to sit in the armchair of a businessman, and it will not be a reclining, relaxing armchair, but it will be armchair which is say something akin to what you may find in the jailer's room, or when electricity shock is to be given to you, and try and find out as to what really is driving the transaction. As he very rightly said time and again, and we will see it as we go along the case studies, is that now the tax officer has ability to ask you why you did it, in a particular manner. Could you not have done it in this particular manner? And he is not going to stop, or we are not able to ask him to stop by saying that you ask us a question whether or not I did the transaction. So this look at principle which is there provided in Vodafone is now no longer applicable. Vodafone SC ruling itself admitted that look-through could be provided in terms of a statutory provision, and we have a statutory provision which talks about look-through aspects. The aspects which we did hear about round-tripping, self-cancelling transaction, inert transactions, these are the words or the synonym of the words that we will find also in the GAAR provisions. That means that while judicial GAAR or JAR could have been applied, and there could have been dispute or debate as to whether or not look at is holding the field and look through is not a permissible. So far as GAAR is concerned, now you have to go on the basis that look through is here and it is a permissible thing. As Yogesh rightly put it, it is in the notice that assessing officer will give to you that he has to identify 4 things. What is the arrangement? He has to then tell you basis, material and evidences as to why he believes that main purpose of that arrangement is tax benefit. There are tainted elements which are there. There is a debate as to whether those tainted elements are alternative or not. The reference which Yogesh gave. Having regard to the SOCO's notice or 144 BA provision and the rule that we looked at, it appears that these are the alternative tests. At least government believes these are the alternative tests, and they have separated them by the conjunction or. And once he does that, then he has to tell you as to what are the consequences that he is going to do. So the steps are identifying the arrangement, telling you then why the main purpose of that benefit or why the main purpose of that arrangement is tax benefit, how the tainted elements tests are fulfilled, and then what are the consequences. So how assessing officer is going to look at it, perhaps in exactly the converse manner, the taxpayer will also have to say that though you may feel this is the arrangement, no, this is my arrangement. That I have done it for commercial purpose, this is the substance of the matter. None of the tainted element test is applicable to me, and therefore you can't invoke GAAR. So these are going to be the battle that will be be seen over a period of time. Now with this as a background, if we take the first case study, and this is more to understand the scope of an arrangement. So you have ICO, presently it is held by A and B. A is holding 90% of the shares, B is holding 10% of the shares. ICO makes right issue. Right issue is done, we are told, at par value, and we are also told that it is much below the fair market value of ICO shares. B subscribes to shares. A abstains from picking up the rights that he has. As a result, post rights, the expanded capital base reflects A as holding only 10% and B as holding 90% of the shares. Now under GAAR, AO wants to recharacterize the arrangement. He looks, to him this looks something very unusual, non-bona fide. So he feels that either there is A who is effectively transferring his interest in company ICO to B, either for a consideration or by way of gift, and he wants to apply GAAR. A and B both presently are wanting to resist GAAR on the basis that there is no arrangement. What A has done is absolute unilateral abstinence that he has done. On the contrary, he has not done anything. He has not subscribed to shares. So apart from the fact that it is unilateral decision, there is no positive action on his part, and hence there is no arrangement because you don't see any transaction happening from A's perspective. It is some effect, it is just coming in because B did what was entitled to him and he subscribed to rights. So question is, how do we look at the arrangement? And as Yogesh Bhai mentioned, we have a very wide definition. Of course, it is given in an exhaustive manner, but at the same time it has got many connotations. It refers to step in or a part or whole of any transaction, operation, scheme, and agreement or understanding, whether or not it is enforceable, and includes the alienation of any property in such transaction, operation, scheme, agreement or understanding. Now, we have seen what is there in MLI, that is the treaty which comes up on account of BAPS. It also has a similar wide definition. If we look at the GAAR provisions which are subsisting in various countries, you will find a similarity in this definition and the definition which is available in very many jurisdictions. When you go to Australia, you find that there is a specific reference to including unilateral action. So, when a country wants to cover unilateral action, they have made a specific provision. So here, taxpayer wants to argue that look, you have to cover either transaction, operation, scheme, agreement or understanding. Transaction is admittedly between two people. Agreement is also between two people because two people come and agree. Understanding is also when they informally come to some ad item conclusion. So that is also meaning that there is a collective action or a bilateral action being taken. And therefore you read operation and scheme adjusted in generis, and therefore unilateral transaction cannot be covered, particularly by citing Australian definition to say that if you wanted to cover unilateral action, you ought to have made that extended provision. Is that the correct contention? Perhaps answer is no. So first we answer to a very simple question, is abstinence, not doing something, can also be an understanding? Answer is yes. Because we have seen agreement of no compete is also something you don't do anything. You on the contrary decide that you don't want to do something. So if no compete agreement is agreement, abstinence can also be an agreement. Can unilateral action get covered? So for that we may need to see operation and scheme. Now if we see the dictionary meaning two terms, operation and scheme. It refers to an effect brought about in accordance with a definite plan or action, or it is a design or plan formed to accomplish some purpose or plot. Now when you look at a plot, a scheme, and if you people have seen Wazir's movie, you are able to see that Amitabh Bachchan did a plot keeping Farhan Khan absolutely in dark. So it was his plan, he admitted, he implemented. So plan or scheme, operation or scheme, these words are wide and they can take into account unilateral action or a decision to the extent it has capability of impacting the other people. We'll come to some other examples also. But the message here is that abstinence can also be an arrangement, and unilateral plan also can be an arrangement. Now, here if we look at our mythology, and if you see, go back to Mahabharata days and Yudhishthira is asked a question, Ashwatthama is dead or not, and he says yes, Narova Kunjo. Now this is the first instance of gullible thing that he has done. He never meant to answer the question, but he did that in a gullible manner. Now, did he do it in a unilateral manner? Did he do it after arriving at understanding with all the seniors and taking blessings of Krishna? Yes, possible. So it was an understanding. When he actually did it, he did it unilaterally, because the question was not asked to anybody else. So the message here is that unilateral actions are also likely to get covered, and let's see what are the unilateral actions which can come. And one example Yogesh Bhai covered in his presentation was that Beck's MLI gives you an illustration that by holding board meeting at a place other than the normal place of your business, you can change poem residence. So you can get the treaty benefit. Of course, our GAAR targets at it, but since we are looking only at the meaning of arrangement, the example here will tell you the illustrations where unilateral actions can get covered, and they are shifting poem from non-treaty favorable jurisdiction to treaty favorable jurisdiction. So a company was a resident of Cayman Island till yesterday. It just goes to Mauritius and then it says, I am poem resident and please give me benefit of the treaty. It's not something which we are talking in theory or in vacuum. In UK, there are two reported cases, Smallwood and one other recent decision, where round-robin scheme was adopted. So, a UK company which otherwise had poem, infrastructure, everything in UK, it shifted its residency to Mauritius. Then it said that being a resident of Mauritius, it is not liable to pay tax. So it shifted, the trust shifted its board to Mauritius, claimed itself to be a poem resident for a while. It sold the shares and it again went back to UK. Now, this is something which is clearly GAAR tainted, and even independent of GAAR, under judicial provisions, this was held to be an empty transaction, inert transaction, which had no commercial consequence. In fact, that reminds me of one example which I had heard from one of the very seniors as to how the GAAR started. So, moment the tax came, tax avoidance came, and that's where the GAAR started. So, in very old days, there was a tax levied on the slaves. In the Europe, the tax was levied on the slaves, and it was a monthly tax which was levied. So the king's people will come and visit the houses. They will count how many slaves you have, and they will make you pay tax. So what was done? That whenever the date arrived, and whenever they came to know that okay, the king's men have come to the neighbor's place, next is our house, let's hide our slaves in whichever hiding place that we can do. So for the time the slave, for the time the king's men are in your premises, the slaves are not there. You don't pay tax. But moment they are gone, you are back. So these are commercially inert transactions which can be targeted under judicial GAAR, and these are also the examples that you can do something in a unilateral manner and it can have tax avoidant impact. So going further about these unilateral examples are changing residential status by an individual when he has to say large chunk of his overseas assets, converting stock in trade into capital asset or vice versa. A director resigns around the time he has to take benefit of the company and he wants to avoid trigger of section 224(4). Conversion of a firm into firm or LLP or firm or company into LLP. Action of a trustees of a discretionary trust to distribute income in a manner or refrain from distributing income are the examples of unilateral transactions. Now coming back to here, how will this arrangement be looked at? You know, A will be asked the question. So now answer is clear that A and B are not permitted to say that because it is abstinence or because it is unilateral, this is not an arrangement. So A and B will be asked a question as to why A is not subscribing to rights which are really available at throwaway price. Of course, he cannot perhaps put forth an argument that I don't have money, because it's quite possible that a person in his all senses would subscribe to shares maybe by borrowing loan, because you are getting the shares at a peanut amount. Question then will be, is there some other unrelated transaction where B has done similar sacrifice? Is there some self-cancelling transaction happening? Here A is sacrificing, where somewhere, is there some other quantum correlated transaction where B is sacrificing? Is there a risk of exchange there? And alternatively, if nothing of that sort is there, why cannot be it regarded as effective gift if A is doing in favor of B? So, if A has not subscribed, is not his intent to effect gift in favor of B. So that perhaps is the understanding so far as arrangement is concerned. That takes us to the next case study as to how does one calculate 3 crore of limit. So in rule we are told that GAAR will not be applicable if tax benefit in the relevant assessment year is less than 3 crores of rupees, and it is also defined for the purpose of rules that tax benefit for the purpose of rule only includes tax. If we see the definition of tax benefit in the main act, it covers any amount payable under the act, and theoretically it can extend even to interest and penalty. But so far as rules are concerned, the tax benefit is defined to mean that the reference is only to tax. So in a situation where the arrangement has tax of less than 3 crores of rupees, there is a de minimis exemption available and GAAR provisions are not to be made applicable. So you have threshold available, you are kept out of GAAR, you do not have to answer to that. The next question is, how do you reckon the relevant assessment? Do you look at the arrangement? So I have not yet referred to the fact pattern, but assuming there is an arrangement which is likely to extend over a period of 10 years, then do you take tax benefit for the whole of the arrangement or do you take it for the relevant assessment year? The language of the rules seems to be explicit and clear that it is the relevant assessment year. CBDT clarification on this count is also explicit. Therefore, one needs to determine the tax benefit on a year-on-year basis. Now, how does one determine the tax benefit? And that really takes us to the slide where Yogesh Bhai talked about evasion, avoidance and mitigation. So, if I have made investment in interest-free bonds, can the tax department say that there is a tax benefit in the arrangement because you ought to have invested in bank fixed deposits or you ought to have gone and invested in a stock market or a mutual fund and then undertaken short-term transactions? no, because the whole arrangement there is to make an investment, and each investment decision that I am making has very, very different implications for me. So in a situation where I do a transaction in one shot manner, very, very unlikely that tax department may succeed in proving that I am being driven by the main purpose of the tax benefit. So with this as a background, just look at this case study. So here we are asked to presume that GAAR is invoked. We are not looking at whether PPT is applied, PPT is not applied, but we are told here GAAR is invoked. And the arrangement is that USCO has financed MAUCO with equity, and MAUCO has financed ICO with CCD. So when Indian company pays interest to Mauritian company, it will pose tax at 7.5% being the treaty rate. Now, supposing if MAUCO was not established, and that is what is treated as a GAAR tainted step. If MAUCO was not established, and if USCO would have invested directly into CCD of ICO, ICO would have paid tax interest to USCO by withholding tax at 15%. So Indian source taxation would have been at 15%. And assuming that treaty benefit is not to be made applicable, it is very likely that so far as CCD is concerned, section 115A is unlikely to be applicable, and domestic law withholding might come to 40%. Because you are paying interest in respect of a debt which is not incurred in foreign currency, CCD being a debt which is reflected and serviced in terms of INR is unlikely to be treated as a debt incurred in foreign currency. So you have three rates: 7.5%, 15% and 40%. What we are told here is that interest which is paid on an annual basis is 30 crores. Now, how do you calculate tax benefit? So you do a counterfactual comparison. How do you determine counterfactual? Department says that if instead of coming via Mauritius, had US company lent directly funds to ICO, what would have been the tax liability? So the answer there would be that tax liability would have been at the rate of 15%, that is 4.5 crore. Since it has come via Mauritius, what is the tax liability? 7.5% of 30 crores, that is coming to 2.25 crore. And if you take the differential, it just comes to 2.25 crore. One could have taken a view that GAAR is not to be made applicable because you are below the threshold limit of de minimis threshold. Now here, can judicial GAAR be applied? Very much possible. Because under the treaty itself, presently there is a condition that whenever interest is paid, it needs to be paid to a person who is the beneficial owner of this interest. Now department under judicial GAAR will tell you that beneficial owner of this interest is US company, and therefore he will apply the treaty rate which is applicable to the US company. Now let's see how under GAAR the things can change and what could be the circumstances under extreme situations. And if you recollect, Yogesh Bhai had referred to section 98 where the consequences of invocation of GAAR were provided. And let's see how those consequences can make a differential impact so far as this structure is concerned. Now, assuming the tax officer identifies that settling of MAUCO here is a tainted step and that needs to be disregarded. So what he may do under section 98 is that he may treat that formation of MAUCO is as if not carried out, or he can disregard MAUCO as an accommodating party, or he can treat MAUCO and USCO as one of the same person, or he can reallocate interest income from MAUCO to USCO. Now these are the four alternatives that are available to him. But under either situations, the income gets allocated to US company, and since section 98, he has to implement the consequences which are appropriate to the facts of the case. Here, perhaps he will have to determine whether or not USO is entitled to treaty benefit, and if entitled to treaty benefit, give the benefit of 15% which is available in India-USA treaty. But matter doesn't stop here. Section 98 has further enabling provisions, and what are those two further enabling provisions? One of the enabling provisions in section 98 is that the tax officer can treat the place of residence of MAUCO as that to be without substantial commercial consideration or commercial purpose, and hence he may want to relocate MAUCO's residence to USA because he believes that rightfully MAUCO should have been in USA, parent is in USA, it is being controlled from USA, so let's take it to USA. Now if he were to invoke this as a consequence, then MAUCO will become or will be treated as a resident of USA. It does not have treaty residency of USA. The treaty benefit goes away and domestic law will apply, and as we have just seen, the domestic law under this circumstances does not stop taxability at 20% as provided in section 115A. It is likely to take the tax liability to 40%. Now one aspect here we may consider is that how the tax officer is able to approach USO. In the first consequences, first 4 or 5 consequences which we have seen, he is reallocating income to USO. He is disregarding MAUCO and going to USO. Under the judicial GAAR, he would have reached USO on the ground that MAUCO is nominee or an agent of USO, and that consequence would have taken him to USO. Now, that is not what he is suggesting. He is wanting to invoke GAAR. Now, USO here wants to take a simple position that, look, I have not received any income. If I have not received any income, where is the question of any tax being payable by me? And if there is no tax payable by me, where is the question of you attributing any tax benefit to me? So really the question is, under GAAR, how do you, upon recharacterization, upon reallocation, upon taking it to some other entity, invoke GAAR when particularly the income is not earned by that person? Now answer to that is provided in GAAR provisions itself. So section 99 says that for determining whether or not there is a tax benefit, the tax officer is permitted to regard two connected persons to be one and the same person. So tax officer will say that MAUCO and USO are one and the same purpose, and therefore it is effectively income earned by USO. It can look through the structure, so it will look through MAUCO and then attribute it to USO. Or it can also say that one has to ignore MAUCO and therefore once again apply the tax benefit in the hands of USO. So these are the messages which we had from the second case study, and I think this case study will once again bring to foray what is the impact of a judicial GAAR that you can have, what is the impact between SAR and GAAR that you can have, something for which the background has been set so very adequately and beautifully by Yogesh Bhai in his session. So now, what's the example that we are looking at? And somewhere here we will also debate on onus of proof and scope of section 96 subsection 2, which is something which we are really struggling with. There is no answer. Would be happy to have thoughts from anyone from the floor. So let's first look at what are we looking at. So A and B are brothers. A is financially affluent. Son of B recently died in an accident, and the son is survived by his widow and children. A, out of concern for B's family and well-being, gives a sum of rupees 10 crore to B. Now this 10 crore is also something which is curiously poised, because if you come to a conclusion that there is a gift taxation happening, and the gift taxation is happening in the hands of B's daughter-in-law, and if she doesn't have any income, very likely the tax liability and a benefit may not cross 3 crore of rupees because of the threshold that you have, and you may not then apply that. Then the question is, how do you look at it in terms of a judicial GAAR? Now, B out of his own volition, so A gifted to B, but B, we are told, out of his own volition, gives sum of rupees 10 crore to his daughter-in-law, that is son's widow. Now gift by A to B is exempt under proviso 1, Roman 1 to section 56 to 10, because it is received by B from his relative, that is his brother. Gift by B to daughter-in-law is also exempt under proviso Roman 1 to section 56 to 10, as daughter-in-law receives also from a relative, because husband's father is regarded as relative. However, had A made gift directly to B's daughter-in-law, it would not have been protected under section 56 to 10. Can GAAR be invoked to tax B's daughter-in-law? Now, before we come to section 96(2), let's see what are likely to be the allegation of the tax authority. He may say that, look, I have a letter available where A very clearly stated that his desire is to give gift to the daughter-in-law, the bereaved family, that he is concerned about the daughter-in-law and her family, and therefore gift is to be given to the daughter-in-law. He is taking an undertaking from B that he will immediately give gift to daughter-in-law, and on a back-to-back basis, the amount is immediately transferred to daughter-in-law. Now, can GAAR be applied? Is there an arrangement? Assessing officer will say yes, there is an arrangement, because what has been done, that instead of giving gift directly to the daughter-in-law, which is the substance of the matter, you have inserted a step of giving gift to B, which has no other commercial purpose except ensuring that provisions of section 56 to 10 protect you from the gift taxation, and as a result of it, the main purpose of this arrangement is to obtain tax benefit. He may thereafter also suggest that many of the tainted element tests are fulfilled, that there is a abuse of the provisions. Just to recollect, we have 4 tainted element tests, namely that transaction has to be at arm's length, it has to create rights and obligations which are created at arm's length. There should be no direct or indirect misuse or abuse of the provision. There should be a commercial substance, or there are provisions which says that deemed commercial substance, so those provisions should not be triggered, and you should not carry out transaction in a manner which is not ordinarily employed for carrying out a bona fide transaction. So he will try and say that ALP of course is not applicable because it's a social transaction, a gift transaction. So leave aside this, but there is a misuse or abuse of provision because you want to protect taxation of gift transaction. The substance of the arrangement here is that the gift is directly given to the daughter-in-law, and there are steps which are inserted which do not have any other commercial substance. Effectively, B's presence here is that of an accommodating party, and as an accommodating party, his presence can be ignored, and you are carrying it out in a manner that one would not ordinarily employ, because if you wanted to give gift to B, if you wanted to give gift to the daughter-in-law family, you should have directly given it to her. So these are likely to be the contentions of the tax officer and likely to be the contents of the show cause notice. Now, as we have seen, one has to try and ask substance. So, why you did it, why you did in this manner is the question which the assessing officer has asked. Because there is a step involved, there is a greater difficulty so far as the taxpayer is concerned. But what are likely to be the contentions from these side? Or what are likely to be the contentions from the daughter-in-law side or from the parties who are to this arrangement? So it was not, one is that tax officer has some incrementing evidence whereby he is able to say that A directed B to give. But assuming there is no such incrementing evidence, cannot B say that I could have kept funds with myself, but look, I am myself not well, I am not sure with the shock of my son's demise, I don't know what is the frame of mind that I have. My daughter-in-law is quite capable of handling these funds, and that's the reason I have handed over those funds to her. She knows her children's future better, so that is the reason I gave gift. So it was absolutely my own decision to give gift. I need not give her the whole gift. I could have given part of that amount to her as the gift. It could also be that, A gave gift because there was a brother-in-law. A may not have given gift if brother was not alive or was not available. And A himself may have intended that B should support the son's family. So all these are the commercial factors which the parties will have to bring on the table to say that this is not an interconnected transaction, but it is a transaction which has each of the steps has a commercial connotation. Now, that takes us to another important aspect as to how do you look at it in terms of a judicial term. And now, this question has been considered in the context of section 64, where the clubbing provisions get triggered. So if there are A and B, if A gives gift to B's wife and B gives gift to A's wife, both A and B will claim that clubbing provisions are not attractive because we have not given gift to our respective spouses. Instead of that, if A were to have gifted it to A's wife and B were to have gifted to B's wife, clubbing provisions would have been attractive. So what do you have under such situation? And it is really instructing to note this extract from Panchwala Sahib's commentary. That the correct text, and we can in fact go to the last line, having stated that one has to determine whether the transactions are connected or not connected. The correct test which has to be applied in the case of cross transfers is to find not whether they are interconnected or not, and if they are so interconnected, whether they are parts of the same transaction and whether they were affected in such a way that they can be said to have been adopted as a device to evade the implication of this section. So assuming the device is proved, assuming the tax officer is able to say that B's intervention was only for the limited purpose of ensuring that he acts as a conduit or an accommodating party, then even assuming the de minimis threshold of 3 crore is not crossed, very likely under judicial GAAR, even under sort of what we may call it a look-at approach, such inert step can be disregarded. Now with that, we just go back to section 96 subsection 2. Something which Yogesh Bhai referred to when he discussed about onus of proof. Difficult to understand the exact scope and purport of this. Before that, it may be good to look at Rule 10 UA. That for the purposes of subsection 1 of section 98, that is where the consequences are to be determined, where a part of an arrangement is declared to be an impermissible avoidance arrangement, the consequences in relation to tax will be determined with reference to such part only. So it's very explicitly stated that if you have an arrangement and if there are multiple parts and if tax department has proved that a part of the step is GAAR tainted, then he cannot apply consequences with regard to the whole of the arrangement. So this is perhaps undisputed and given. Perhaps this is not getting diluted by section 96.2. And let's now see, we of course looked at 96.2, but just relook at 96.2. And let's try and understand with an example as to what really it is trying to achieve. So if you see, the word arrangement is referred to at 3 places here. An arrangement shall be presumed unless it is proved to the contrary by the assessee to have been entered into or carried out for the main purpose of obtaining a tax benefit. If the main purpose of a step in or a part of the arrangement is to obtain a tax benefit, notwithstanding the fact that the main purpose of the whole arrangement is not to obtain a tax benefit. And just let me give you one example. Suppose if I am going from Mumbai to USA and I have to go via Dubai, UK, Canada, and then let's say I go to USA. It's a one journey that I have, but I have intervening stops in between. Now at Dubai airport, I am found guilty of doing some misconduct. So in a step, I am found to be a guilty and authorities at the airport prove that I am guilty of misconduct. So that is, the authorities have to prove that my step is the tainted. It is for the main purpose of obtaining tax benefit. Then what is the fiction and the presumption that this provision is trying to create? Now, for the whole of my arrangement and at each stopover that I will have, the authorities can ask me to say that and to prove that I am not a guilty of misconduct. That whatever that I did for that step is something that I did limited to that step. But this provision permits the tax authority or the airport authority of each of the subsequent airports, and they can ask me without proving anything that whether or not I am guilty of misconduct. So this seems to be lightening the burden of the tax authority to prove the onus or to prove the main benefit of the subsequent steps. And the provision also tells me that I cannot serve my responsibility of proving that I am doing it in a bona fide manner by contending that look, my purpose is only to move from Mumbai to USA. So the fact that the whole arrangement is not for obtaining tax benefit but for going to USA is not something that I'll be able to contend. Now that takes us to another case study, and this highlights that perhaps GAAR does not have that strong teeth to bite whereby it can catch you if you are doing something in a one bullet, one shot and in a transparent manner. In the earlier example, on the face of it, to us also on a smell test, it appeared that the intent is to give gift to the widow. But brother came sort of as if for a non-tax purpose, and we had anxiety over applicability of the GAAR. Main purpose was getting proved easily, the tainted element test was also getting proved easily. But let's see what happens on the applicability of GAAR when a particular transaction is implemented in one shot and a taxpayer is doing something which on the face of it mitigates tax liability, but he exercises his choice of implementing a transaction. So this is more to bring home the point how the choice principle can still remain protected even if wide provisions of GAAR are sought to be applied. So we have a WOS which is engaged in manufacturing automobile, so you can presume whatever is the nature of business. So you have complete 100% relationship. Shares are held in physical form, they are distinctly identifiable. WOS has huge accumulated profits which are plowed back in business, so this company does not have dividend track record. Perhaps WOS had contemplated some business expansion which we are told is given up in the recent past, and therefore WOS is proposing to buy back shares at fair market value. So that is what is given to us. Here in buyback offer, Holdco is tendering its shares, and if you see this, we have three tranches of shares. One with the issue price of 10, another with the issue price of 30, and the third with the issue price of 60. And let's say the WOS pays 90 crore to Holdco. Now, what will be the buyback tax liability? Because it's a transaction of buyback, buyback tax liability is calculated by taking into account difference between 90 crore and issue price, which is 60 crores. So 90 minus 60, buyback tax liability calculated with reference to 30 crore, and a buyback tax liability say comes to 20% of 30 crores, that is 6 crores of rupees. Now department, as you know, they would want to say, what are they indicating? According to them, the company which has kept the shareholder so much deprived of dividend for so many years should have naturally and bona fidely given this amount as a dividend. It did not opt for the dividend payment, and therefore what it did is GAAR tainted. So it gives you a counterfactual that you ought to have, or WOS has actually declared dividend, which because it's a WOS and a holding company relationship, even if it is shown as buyback, makes no difference to the parties. So I regard this transaction as a transaction in substance of involving dividend payment. And if you pay dividend of 90 crore, the tax liability would have been 18 crore. There is a tax benefit because it is 18 crore minus buyback tax of 6 crore, and therefore 12 crore is tax benefit, and I am invoking that. So main purpose, he says, is that of obtaining tax benefit. Now, you know, here he will really struggle to find out how are the tainted element tests getting fulfilled, and these are the two cumulative conditions. Not only he has to prove that main purpose is tax benefit, but he also has to prove that the tainted element tests are fulfilled. Now, if you really regard this tainted elements test to be cumulative, very likely he will not be able to fulfill many of the conditions, but let's for a minute admit that these conditions are alternative. So he will try and struggle and try and apply any of those tainted elements tests. Is it arm's length transaction? We are told it is at fair price, ALP is fulfilled, so no question on that. Is there misuse or abuse of provision? Buyback itself is a SAR. Buyback itself has rules such as you are told how do you determine distributed income, and buyback rules themselves support specific identification method. So you have not misused or abused any provision, you have not done anything in a manner which is very subconscious. So misuse abuse test is also unlikely to be fulfilled. The third is commercial substance or a deemed lack of commercial substance. I will come to that in a while, but the fourth test is that have you done it in a manner which would not ordinarily be done had it been a bona fide transaction. So how do I do buyback? I do buyback by complying with the provisions of the Companies Act and the FEMA. I have complied with all the provisions, matter hence I have done it in a bona fide manner. So even that test is unlikely to be applicable. Commercial substance, it is buyback. I am saying it is buyback. Everybody on the planet says it is buyback. How can you disregard? So on a general principle, commercial substance is fulfilled. But then the Act has deemed commercial substance lacking provisions. And one of the provisions in a lack of deemed commercial or a deemed commercial substance, the deeming fiction tells you that if the transaction does not have any impact on a cash flow or a risk of the parties, it would be deemed to be lacking a commercial substance. So now the tax officer has this as a weapon. He tells me that look, yours is a 100% holding and a subsidiary relationship. Whether you pay buyback or a dividend, except for tax benefit, there is no impact which is happening on a cash flow of both the parties. There is no consequential impact on the risk, and therefore this tainted element test is satisfied. So he feels empowered that he has done what all that he was required to do by section 144 BA of the Act. Now, what are the defenses? And you feel strong about these defenses. So first of all, what is the object of the arrangement? This company WOS had surplus funds. It does not require surplus funds. It wants to return back those surplus funds. So it is the object that it wants to return. So when I have surplus funds and when I evaluate various options as to where do I invest, in bank deposit, in equity market, in mutual fund market, or I deposit in tax-free bond, I am making decision of an investment. So here the main object is to return the funds, and the fact that I am opting or selecting a method which is the least tax burdensome is not enough to say that the main purpose of this arrangement is to obtain tax benefit. GAAR is not an instrument to say that you have to make worst of your choice and become so generous that you go and pay maximum possible tax that you can pay to the government. That's not the intent of the government. Luckily, the circular acknowledges that a taxpayer has right to choose or select a method of implementing a transaction. So that is what the tax department, that is what the taxpayer would want to rely. Secondly, it is wrong for anyone to say that buyback and dividend has the same impact. We have one transaction where similar WOS and a holding relationship. That company was overcapitalized because earlier FEMA required that being NBFC it should have capital of 15 million. Now it never wanted those funds, but because it had to do regulatory compliance, it capitalized it at 50 million. Now that restriction is gone and they have surplus funds. In fact, they had capitalized in a manner which was contrary to their business. They received the funds in India, they kept deposited in bank deposit, offered that income to tax as income from other sources, and now they say, okay, regulatory requirement is gone, why not I give back the money? If my capital is different or is controlled, I do not have to rotate auditor, and I like BSM as an auditor so much that I would rather ensure that my capital is controlled and I do not have to rotate. So, dividend payment and a buyback has its own commercial differing implications, and in a GAAR, the tax officer is not permitted to leave me in a manner that I am commercially differentiated. He has to remove that taint in a manner that ultimately, commercially, I remain neutralized or I remain equally in the same position. Now, on the tainted element test, that whether really there is impact on the risk and the cash flow. So far as that commercial substance, being lack of commercial substance to which I made a reference, for applying that tainted element test, the tax officer does not have benefit of section 99. If you recollect, what was that section 99? That he can collapse USCO and MAUCO and say that there is a tax benefit obtained. So for a commercial substance test, he does not have that as a resort, and accordingly he will not be able to say that I have to look at the cash flow position on a group wide basis. He will have to say cash flow position on an individual basis, and the cash flow is really shifting from the subsidiary company to a holding company. So there is a cash flow impact also. So he fails on that tainted element test. Now just the last point on this is, was it required to follow FIFO method? Was it required that the offer should have been of 10 rupees of share and not of 60 rupees of share? Answer is that it's a identification. Here the shares are identified. Buyback tax tells you that you have to calculate distributed income taking into account what is the identifiable issue price. Buyback provisions also takes you to FIFO method and a fiction of a FIFO method provided shares are not identified. Here the taxpayer has identifiable shares and would believe that on the basis of respecting a choice principle, which is done in a one-shot manner, the taxpayer here perhaps is right in saying that his buyback tax liability will also need to be calculated with reference to reduction of 60 rupees and not on some other presumption of FIFO. Now, that takes us to another aspect. To an extent, this mimics with the case study which Yogesh Bhai referred to in the context of LLP conversion, where you want to comply with section 47 exemption conditions and you want to control that so far as BCO in this example meets with the turnover requirement and is able to have a tax neutral conversion. So something like this. So first we saw a situation where there was a step, and just to remind ourselves that whenever the step is involved and whenever you do something wrong so far as step is concerned, I did something wrong at Dubai airport, 96(2) comes into play and the tax officer's task gets facilitated. So whenever there is a step, the life becomes more challenging. One-shot transactions are likely to be more accepted as a commercial transaction. So here, what is the fact pattern in the light of this? And with that, then we'll go to the last of the case study where we will once again refresh ourselves about PPT and interplay and how one really can look at it. So here we are told that you have Holdco which has got two subsidiaries. ICO 1 has land. ICO 1 business is totally discontinued, so except for land there is nothing. ICO 1 wants to dispose of the land and therefore it is already in dialogue and conversation with the prospective buyers. As against that, the Holdco has another subsidiary where some significant losses are there, both in terms of carry forward for the purposes of MAT as also for the purposes of normal computation. So what are they doing? They enter into an arrangement whereby ICO 1 gets merged with ICO 2. And when the merger is recorded, it is recorded at fair value, something what is permissible when IGAP is applicable, may not be applicable when Ind AS becomes applicable. So presumption for us is that IGAP is applicable and land is recorded at fair price. So say the cost of land in the books of ICO 1 is 100, the market price is 1000. In the books of ICO 2, it will get recorded at 1000 rupees. And since it is market price, the ultimate realization will also be close to 1000 rupees. Now, once it is merged, and in fact we are told that even before the effective date of merger comes, land is sold and relying on Marshals, ICO 2 says that it is me who has to pay tax and therefore for me the cost is, for the purposes of books, 1000. I have realized 1000. Nothing gets credited to my profit and loss account, so I don't pay any MAT. I have enough carry forward in terms of capital loss. I have enough carry forward in terms of unabsorbed depreciation. So 1000 minus 100, the cost substitution, 900 of capital gain, but I set it off totally and the tax liability is determined at nil. So ICO 2 pays no tax. And now the question is, can GAAR be applied? Can GAAR be applied to the book profit calculation, or do you say book profit remains immunized? And what are the likely defenses which a taxpayer can have to say that GAAR is not to be made applicable to him? Now how will tax authority look at it? So perhaps they will say that look, you had ICO 1, no business, ready for divestment of its only asset left out. So the question of your merging and saying that you wanted to have synergy and you wanted to have operational efficiencies, all these are, please keep it to yourself. These are not accepted. So by supposing if this merger had not happened, what would have happened? ICO would have paid tax, maybe MAT, assuming it had any depreciation carry forward, at least it would have paid taxes. It would have upstream dividend to the parent, so it would have paid DDT, and then parent would have infused. So these are the elements of tax benefit which can be taken into account for determining whether threshold is crossed, whether your main purpose is tax benefit. He also invokes 96(2). He regards merger to be a step inserted for achieving the overall commercial objective of monetizing land, of infusing these funds in ICO. So he regards that to be a step, and his burden, as we have seen under 96(2), as per one alternative, gets softened. He also then, once main purpose test is crossed, the tainted element test becomes easier. So according to him, you did misuse or abuse of corporate reorganization provision, something what we looked at it in Everett decision which Yogesh Bhai mentioned from US context 1935. So you misused and abused amalgamation tax neutrality provisions, which is something which really you never wanted to have the merged entity which would do certain things, so you misused and abused the provision. Perhaps you inserted this step which had no other commercial purpose, so a non-bona fide manner in which you achieve the tax benefit. So he will succeed in suggesting perhaps that tainted element test is fulfilled. Now, the thought process and a commercial instances and the considerations, one could come out of reality and it could also come out of imagination. So let's talk what could be the reality, alternative reality where perhaps the GAAR could be defended here. So the fact that the transaction, the land was proposed to be sold, is not equivalent of saying that ICO 1 wanted to sell the land and it concluded selling it. In fact, we have likewise one other old decision where on the meaning of arrangement, a transaction was, a property was proposed to be sold, there were negotiations going on, the property got transferred to the other person. The other person actually sold the property to the third party with whom the negotiations were going on. And when the look-at principle was a fail or perhaps was in more vogue, the court said that the fact that you undertook that transaction in reality and you did actually transfer to the other person cannot be disregarded. And the fact that negotiations were going on is not equivalent of saying that actually the deal had happened. So you can say that the fact that negotiations are going on at ICO 1 level is not good enough to support that actually ICO 1 wanted to sell the land. Perhaps ICO 2, after receiving the land, could have used for the purposes of its own business, could have mortgaged the land, could have raised the funds. It is due to some differing circumstances or some unexpected development had happened, and this land shot up so much in a value that they took decision to sell them. So these could be likely contentions that can be raised. Of course, it is a smell test, it is the overall feel of the matter which will hold the field, and it is likely, depending on where the weight is tilting, that one will determine whether or not GAAR is applicable. But this is one example where the step is inserted and the taxpayer is likely to have a greater difficulty. Now, one technical aspect here. Can ICO 2 or can taxpayer suggest that so far as MAT is concerned, GAAR cannot be made applicable? That so far as MAT is concerned, it's a book profit based concept. That one pays tax with reference to book profit. Applicability of GAAR is something which is outside the actual transactions are happening. MAT is based on the actual transactions as are happening, and therefore, so far as book profit and a MAT liability is concerned, you cannot apply provisions of GAAR to the determination of MAT liability. So far as MAT is concerned, it itself is an artificial provision. It looks at book profit in such a blind manner that a capital receipt, a non-chargeable receipt, can also get assessed. And if we look at India's framework we have, there are possible views that it can pick up for MAT taxation the amount which are actually representing receipt of amount by way of say CCD or by way of say issuance of a redeemable preference shares. So one would like to argue that this artificial provision needs a strict construction. It is based on book profit, and as a result of it you cannot apply GAAR. That there is a specific provision in section 115JB subsection 5 which says that other provisions of the Act can apply but subject to provisions of book profit calculation. And because all Supreme Court decisions, be it Apollo, be it Ajanta, be it Indorama, all of them have said that only upward and downward adjustments as are provided in the Act that can be taken into account. MAT liability is to be kept immunized from the provisions of GAAR. The counter contentions and perhaps a better view of the matter is, number one, both the provisions have non-obstant provisions. So a subsequent non-obstant provision holds the field. Then, as Yogesh Bhai mentioned in his presentation, that you have section 100, which is a very small but a very powerful arm in the hands of the tax department, that GAAR provisions can be applied in lieu of or in addition to any other basis of determination of income, and GAAR recharacterization or a power of adjustments which is available in terms of section 98 which is there is so overarching that those recharacterization and a consequential powers can as equally be made applicable to MAT provision. So perhaps these are the prospects. We have to see how the judicial development evolves, but prima facie it appears that MAT computation is also likely to be under the taint of GAAR. Now, I'll skip the two case studies and take you to a situation which is the flavor, the BAPS, the PPT, and will of course try and avoid whatever that we have discussed, but see how GAAR can be applied, what is the GAAR grandfathering impact that one can have. So very typically we have this structure, US Co, UK Co, Australia Co, coming either via Mauritius or Singapore, because 50+% of our FDI has come via such entities, and you have FDI. So one is there an arrangement? Because that's the first question that you need to ask. Can UNESCO say that when I made investment in India, here of course it is talking about 2005, so just about 12 years back, but let's say the investment is made 25 years back. Can someone say that there is no arrangement? Because when UNESCO made investment, it's really not known as to whether India company will do good, will it make profit, will it make loss, will I ever exit, will I not come and remain in India forever. So do you have an arrangement? Does arrangement have to be in a manner that it is predictable and you are able to see in a foreseeable manner, look, this is what is happening as the next step. Again an arguable proposition, but it appears that when UNESCO made investment, and if it wanted to make investment in India, why did it not make investment direct? You know, if it was so uncertain, it could have simply made investment, and the fact that it made investment via Mauritius is indicative of the fact that there is a likely tax benefit in his mind. So, merely because the arrangement is a very long-standing arrangement is not likely to be an answer that there is absence of an arrangement. That's proposition 1. Second is, how do you look at such SPV structures which are all prevalent, and you know, when we say 50% plus, how do we look at it when it comes to PPT, when it comes to GAAR? So, whether for GAAR or for PPT, one has to answer two questions. Why is US company making investment through a separate entity and not directly? So what is called a separate entity test. And two, why is US company selecting Mauritius or Singapore as the jurisdiction? So that is a location test. So you try and answer two questions. Why a separate entity and why a particular location? And then this is the question where thing will be, are you there for commercial purpose or are you there for tax purposes? Civility circular tells you that if you have selected a particular location for commercial purposes and for the purpose that the main purpose of such arrangement is not tax benefit, in that event, the choice is to be respected, the treaty benefit is to be granted. Do I have time? The treaty benefit is to be respected. So that is the circular clarification that you have. Now I refer to two aspects. Separate entity test. Why is US company not investing directly? And you know, Vodafone Supreme Court is the decision which is writing for the taxpayer number of commercial reasons as to why a particular entity will not make a direct investment but will make via a particular entity. And if I could just indicate some of the reasons coming from Vodafone decision are that you are selecting a separate entity for a better governance, for hedging business risk, for hedging political risk, for providing mobility of investment, for enabling creditors to lend only against a particular investment, to give limited information to the creditors to the extent they are concerned with that entity, facilitate an exit route, promote specialization. It could be for a regulatory reasons. In fact, you know, for NHAI, there are requirements that for each project you need to have a separate SPV. So you may need a separate SPV because you are asked to do that, or for better return to the shareholder. So these are just the indicative factors which are there from Vodafone decision. So that answers to the separate entity test. World over, it is acknowledged that answering the question of separate entity is easy. You are able to determine that the separate entity test is fulfilled. The second is why a particular location. And if you recollect, we did see one example where, which is there in PPT, that there are 3 locations, each, and a company wanted to establish a manufacturing hub. Each one of them was equally attractive, and you selected the hub which is having a favorable treaty network. It meets object and purpose of the treaty. It promotes cross-border. Such choice even cannot be faulted under a lower threshold PPT. So of course under GAAR, you may be able to say that PPT is sufficiently addressing that particular aspect. So what are the commercial factors? And in fact, if you all recollect AIG decision of AAR and Action Plan 6, it is listing down various factors which one can indicate to say that why am I going to a particular location. And as Yogesh was saying, I go to Ireland for aircraft leasing because now that is the hub. I go to Jhaveri Bazaar for buying jewelry because I know if I don't like this shop, there is another shop, a very well reputed market in a neat, closely knit manner, so I go there. Maybe after some time my choice may change and I may go to a mall for other reasons, is a different thing. But if jewelry purchase is my intent, I go to Jhaveri Bazaar. Very, very likely that I do. So I am doing it for commercial purpose. The financial hub gets created. And you know, just to see what is the flavor of the factors one can consider for establishing that why I am selecting a particular location. So the examples as are, or the factors as are coming from PPT, as also from our CBDT circular, as also from AIG decision are, you go there because you have good infrastructure, so it improves your operational efficiency. You have a skilled and multilingual workforce there. You have a directors with knowledge of regional business practices and applicable regulations. That particular, in the context of EU, they say that the fact that you are there in Netherlands and you want to access treaty network or you want to operate in other European countries, the fact that euro is a common currency protects you from an exchange fluctuation risk, and that also is a good factor. So the fact that it is a part of a group where there is a common currency is a factor. Favorable regulatory and legal framework, political stability, lender and investor familiarity, offshore financial services well equipped to handle the financial services at a low cost, lower cost of legal, accounting and other professional services. Because when you go and establish a manufacturing concern, very likely you have a greater ability to prove that I went for a particular thing. I go to China to get the jewelry manufactured because I know the precision with which the workers will do the jewelry. But when it comes to investment holding company, the task becomes very difficult and one has to really bring on table as to why a particular location is selected. So the separate entity test and a location test, and if this is fulfilled, very likely you are able to meet the preamble test of the treaty, very likely you are able to meet PPT, very likely you are therefore able to meet the stricter test of the treaty. Now, of course, lastly, while GAAR etc. may apply, the buyer, the representative SSCs are though suffering as a vicarious liability, not a primary person responsible for paying tax. They may as equally be under the radar of GAAR and PPT. And with that, let me say thank you very much to each one of you. Thank you.
Friends, we had power-packed 2 sessions till now. The learned speaker took us through various case studies. Each case study went with particular aspects of GAAR, so it helps us to understand that aspect much better. We all been benefited from this session. The sole purpose of Chamber of inviting you, madam, has been met. So I request all of you to carry out this vote of thanks to very loud applause. So the next session will start immediately. The only people who are permitted to get off their chairs are on the dais. So because of the time pressure which we have.
Right.